Good morning. Good morning. Good morning. It's afternoon. How you guys doing this afternoon? Nice to see you guys here. You're correct, Nick. It is afternoon. So great to see you. We are going to jump into the commodities, the world of commodities. Usually this is the power hour and we do a little bit of day trading. We can go look at that as well. But I've had a lot of requests, believe it or not, for people who have accounts who trade commodities, and we've been doing a lot of day trading, but they keep asking, or I've had several ask, if we can do some longer term trading in the futures market and not just day trading. And so I wanted to do a little bit of that. I want to focus a little bit on that today. And I think that would be fun to go through and talk about the commodities market for those people who are just getting started here and joining us and want to learn a little bit more about some of the different markets other than just the stock market. So I just wanted to start our daily routine here just very quickly by looking at the news. And this is my news calendar to see what's the high impact. 8 o'clock this morning, we had the purchasing managers index come through and the JOLTS opening. And I'm going to assume that the market did not like it very well. I'm not going to try and read it myself and say, oh, this was this, and this was the forecast, and this was the consensus. I mean, this is all after the fact. This happened at 8 o'clock this morning, and the market flushed today. So we had a crappy market today. And so I'm going to assume they didn't like the purchasing managers inject and the JOLTS job openings. All right. So yesterday was a great day, big portfolio rally, and then gave, very large amount of it back again today. So let's jump in. With that said, we do have crude oil exchange coming in here at 2:30, but that's after the market closes. So that's not going to help us a whole lot. So let's come in and jump over to the software. And this is the NASDAQ. And as you can see, the NASDAQ is running pretty good. I mean, goodness sakes, that's just a beautiful chart. And we oftentimes say, just trade the arrows, Land, just trade the arrows. And I think that would have been a very good strategy today, just trade the arrows. And so be very mindful of that. Oftentimes when we trade, we have a short window, so we do a little bit more scalping sometimes, but we oftentimes talk about just take the arrows, trade those down, and let your trailing stop trail on those little yellow dots. And that's a nice little strategy. You can't beat that strategy. Of course, we are using a very unique chart, so you have to take that into consideration as well. This is the range bar chart with Heiken Ashi turned on. Now, that's, again, very unique. If we turn off the Heiken Ashi, that's just what a normal range bar chart looks like. And the arrows get a little crazy, so you don't want to do that. And then, of course, if we come in here and we go to something other than a range bar chart, we'd go to a minute chart, like maybe what we have over here in the Dow chart. And this is what you would see. This is what most traders see when they trade. All right. But we're not most traders. We're a little bit smarter than the average bear. And we use a couple of different tools that kind of help it easier. It's kind of like I turn on cheat codes. All right. So I come back over here, and the NASDAQ's a good example of that. We'll turn on our cheat codes in here, and you can see that it makes it a little bit easier to trade, I think. All right. So if you like this idea, that's what we're doing. We're doing the range bar 25. Range bars, of course, mean that there's no time involved. It's just the trend. So each bar could be, there is no time. So it could be however long it takes to make 25 minimum moves, and then it starts a new bar. So that's how it goes. It could take 10 minutes to make one bar. It could take 2 seconds to make one bar. Depends on how fast the market's moving. But it's only based on trend. And we want to see the trend based on 25 minimum moves. Each 25 minimum move, okay, I think that's moved far enough. Give me a new price bar. And so that's why you see these nice smooth trends, because there's no time involved where it's just, I went 1 minute. I guess I better get him a new bar. Well, you didn't go anywhere. Well, yeah, but I went 1 minute. So gives you a new bar. So that's how normal time charts work. But then we add Heiken Ashi to it, which is kind of a new thing. Not really new, but it's kind of new. It's kind of a new thing. Heiken Ashi bars are a mathematically smooth component that's added right to the bar itself. So I like those, and that's what we've got seen here on the screen. And I'm using Track and Trade for those of you who might want to use the same software I'm using. Let's see if I can give you a little indication where you can go to get that. Go over to trackandtrade.com. And you can get both the stocks version and the futures version. We're going to be using the futures version today, and that's what we're looking at right now. This is the futures version, which is out of Chicago. All right. So we have multiple exchanges. There's exchanges that are out of New York. There's exchanges that are out of, all around the world. There's exchanges that are out of Chicago. Many people don't put those two together and think, oh, Chicago has trading exchanges. Yes, they do. That's kind of why they have, think about sports, bulls and bears having to do with trading, right? Bullish, bearish. But yet the Bulls and Bears, those basketball and football teams are out of Chicago. That's because we do a lot of trading in Chicago. And that's kind of my little forte. That's where I spent most of my time at the exchanges back there. About from 2000 to 2010, I spent my time back there running around in the Chicago Board of Trade and the Chicago Mercantile Exchange education centers. And so that's, my heart is soft to the Chicago markets. And you can come in there and get that software and come and join us and just do what we do, follow along. It's a lot of fun. All right. So now, again, these are the indexes. This is the Dow Jones, the NASDAQ, the Russell, and the S&P 500. We can bring all those up on the screen at the same time. And you can see the difference between those markets all running simultaneously. This one here, we want to turn Heikin Ashi back on. And then this is how we day trade, right? But we're not so much interested in day trading today, so we want to venture out a little bit beyond our comfort zone here of day trading and look at some other markets that are popular to trade. And one of those is gold, silver, right? We like crude oil. There's all kinds of other things that we can trade in here. In fact, we can even trade Bitcoin if you want to. And so we can come down here and you see this nice big long list of commodities that we can trade. And let's just go down through them very quickly. You can see we can do a lot of currencies. So if you're into Forex or foreign currency, you don't have to have a special account just to trade the Forex market. You can just do that right here in the futures market. And it's a little bit, in my opinion, safer because you're going through an exchange as opposed to an over-the-counter broker. So, or a dealing desk. And so we try to avoid that kind of stuff. And just, we like exchanges. And so those are safer places, in my opinion. And so you can see all those different currencies in there. We also have feeder cattle and live cattle. Those are fun to trade. I've done a little bit of that, and I enjoy trading feeder cattle and live cattle. We've got copper and corn. We've got, let's skip down here a little bit. There's natural gas. That's a popular one. A lot of people like to trade natural gas. There's our gold contract, Mexican peso. If you want to trade the peso, that's a market that's available to you over here in the futures market. Here's your heating oil, crude oil. We got micro accounts and mini accounts. So let me bring this up, see if I can make this a little larger. There we go. So you can see that we got micro accounts and mini accounts. So you can trade the normal size account. In many markets, there's three sizes. All right. There's the big commercial size accounts that we pretty much going to avoid, right? Those are too big for us. And then there's the regular size account, which is, we trade a lot of those. Those are good size accounts, but there's also micro mini accounts. There's minis, which are the normal, what I call normal. And then there's the micros. And the micro accounts, those are real small accounts. And don't get me wrong, just because they're micros and they're small accounts, they still have a lot of leverage and you can do a lot of good in those markets. In fact, many of them will beat what you're doing over there with a cash account in the stock market. They still have greater leverage than that. So you can see how the leverage is built on these things. We can go do a little bit of comparison on some of these in another class. But right now, just to introduce you just quickly to some of the stocks there, not stocks. We don't trade stocks over here in Chicago. We trade commodities and futures. All right. So what's the difference between commodities and futures, Land? Well, we kind of use them interchangeably, but the reason we call it the futures market, and then we trade commodities in the futures market, but we also trade other things like currencies and indexes, and is because we're trading off a future price representation. So it's kind of like we do forward contracting, if you're familiar with that concept or idea in the futures market, where we buy it and sell it today, but we don't have to make delivery or take delivery until sometime in the future. So that's why we call it the futures market, is because you don't have to take or make delivery on your purchase or your sale until sometime in the future. Therefore, you can buy something and that you don't own, right? Or you can sell something that you don't own. You can buy something and then you can sell, or you can go short. You can sell something that you don't own because you don't have to deliver it until sometime in the future. When the guy who buys it, he can buy something that he doesn't really want, and because he doesn't have to take delivery of it until sometime in the future. So he can just take advantage of the rise in price and then liquidate it and get rid of it before he has to take delivery. that's how the futures market works. It's a little bit different concept than stocks, but not too much different. But you understand a couple of these little minor differences, and it can be a very fun way of trading. All right. So here's heating oil, light crude oil. We got palladium, platinum. We got the Russell down there. Some of these indexes, S&P. There's silver. There's soybeans, soybean meal. Those are oftentimes fun. Soybean oil. Those are good markets to trade. They're like a family. So you have soybean oil, soybean meal, and you have soybeans. And so those three complexes right there, they trade very similarly. But what's interesting is that because they're a family, one will take off and run before the other. And usually that's the retail product. You would think it would be soybeans. It'd be like, well, if soybeans goes up, soybean meal and soybean oil are going to follow. Not necessarily so. What happens is they kind of stay together, almost like the indexes do. They kind of porpoise like that, right? But what happens is you have the retail product, which is soybean oil, which is generally takes off first, and then the others will follow. So what happens is you watch these markets, and when soybean oil takes off and goes to the moon, well, the others will still just sit there. But you're pretty confident that if that one went to the moon, well, the others are going to follow. So you jump on the laggers. That's what I like to do. I like to find these families, like you got crude oil and you got heating oil. That's a lag. That's a family, right? You watch heating oil and crude oil, and if one takes off and goes, well, the other is going to follow. And so you can play these laggers. And so when one takes off, you don't trade the one that took off. You trade the one that's the lagger, and that's a good idea. It works really well. You come down a little bit further, we got the T-bonds and the T-notes. And of course, down here in the bottom, we have wheat. So wheat, corn, soybeans, those are oftentimes considered the most traditional commodities. We got gold and silver, crude oil. Those are the ones that most people like to trade. So let's go in and take a look at some of those here for fun. So we're going to come in and let's create a new portfolio. And we're just going to call it commodities. And commodities are generally considered the traditional commodities, right? Corn, wheat, soybeans, crude oil, gold, silver, platinum, palladium, those types of things. Cotton, orange juice, cocoa, coffee, cotton. Did I say cotton? Sugar, those types of things are the general traditional commodities. And then, the reason we mix it with commodities and futures is because you say, well, the S&P 500 is not a commodity. Well, kind of it is, right? I mean, all these different indexes or currencies are not necessarily commodities in the traditional sense. So that's why we kind of mix it up with the futures market versus the commodities. Can put them all into the same exchange, and we just call it the commodity futures market. All right, because we trade all of them. Even if you're trading commodities, you understand that you have to make or take delivery of sometime in the future. You say, well, you don't have to do that with the S&P 500. So that's what's the point? He said, but we trade it the same way. We trade it exactly the same way, whether it's a currency, like the Canadian dollar, or whether it's the US dollar, or whether it's corn. We still don't take or make delivery until sometime in the future on it. So you can take or make delivery sometime on the S&P sometime in the future. Therefore, you can sell something you don't own, the S&P. You can sell it or short it, right? Make money when the market goes down, and you don't have to actually deliver it until sometime in the future. So you can offset your position, so you can buy it back before you have to make delivery, and you didn't even have to ever own anything that you sold first to take it short. And so that's one way you can trade those indexes and currencies and take short positions and offset them sometime in the future. It's a really neat trick. All right. So they don't charge you interest to do that. There's no penalties. There's no fees. There's no dividends you have to pay if you hold it. There's no, did I say interest? There's nothing like that. If you're going to do it in the futures market. In the stock market, you have to pay all those things if you're going to take a short position. But in the futures market, you don't. Why? Because it's the same as going long as it is going short, because you're going to offset it sometime in the future. So I oftentimes call the futures market the last bastion of true capitalism on earth today. There's no pattern day trading rules over here. You can come over and trade to your heart's content with a small account. It's really cool. It's really fun. And I think it's a great place to be. All right, let's come in here. We got ourselves a portfolio we just called commodities. All right, so we're going to come in here, and you can see I already created a bunch of portfolios in here. One of them's called pigs and cows. And so if you want to, I have just my pigs and cows in there. And so we're going to come in and we can just open up the pigs and cows. So here's hogs, Here's lean hogs and here's lean hogs. And so we can come in here. Oh, I don't have my cows in here. So let's come in and put the cows in here. We've got feeder cattle we can open up. And of course, here's if we also have live cattle. You want to know something interesting about feeder cattle and live cattle is that feeder cattle are alive and live cattle are dead. How about that? So that's kind of an interesting little change up. Let's see. We got February, daily hogs, lean hogs, lean hogs, lean hogs. We got lots of lean hogs in here. Let's get rid of one of these. We don't need this one. All right. So lean hogs are up here in the upper left-hand corner. That looks like that thing's closed. So that's a 2-minute chart. Let's go up here. We don't need that 2-minute chart. Let's go look up here. So we got live cattle. Yeah, it doesn't really fit right well with our we don't have like another meat. We need another meat. We used to have bacon, pork bellies, right? They delisted pork bellies. We no longer have pork bellies, unfortunately. So over here in the futures market, we're kind of stuck with just 3. We got feeder cattle, live cattle, and lean hogs, and that leaves us a big white blank spot to put something in, and I don't have anything to put anything in there. So we could say, well, you know what? We could put something else in there. Yeah, we'll just do it like this. Let's just bring it full screen. Okay. There is lean hogs. Now that's your daily chart. And of course, we've got Heikin Ashi turned on. Each par represents 1 day. And these are just moving averages in here. And of course, we've got the DMI, which is our directional moving average. Let's turn that off for right now. And let's just use the stochastics. And actually, lots of people like the RSI. Let's turn the RSI on. That's a good one. We'll turn off stochastics. They're kind of the same thing. You can see about the same thing. So we'll just turn off the stochastic. I kind of prefer stochastics over RSI, but I'm a big Wells Wilder fan. So, I'll take our RSI. All right. So if we're going to trade the lean hogs, right? And what we want to do is the first thing we want to do is just start doing our technical analysis. So we're just going to come in and start drawing trend lines. And we're going to draw a trend line up through here, right? And we can see that we got a nice trend line. We're going to start off with our little ABC patterns down here at the bottom. This is the first move. You can see it doesn't really, this move from this low to this low, if we draw a little trend line in there, first thing we do, that's kind of, let's make this a little brighter so you can see it. Let's come over here to our preferences. We're going to make that yellow. Actually, let's make it gold, considering that we like money. We'll save that, update all lines. All right, that looks good. But we're not getting much of a trend. We take it like that, and we connect this dot, extend the trend line, boom, that's where our trend line goes way out there. That's not going to help us a whole lot. So we have to kind of go with what the market's already been doing. So let's turn off these moving averages, or let's simplify them so we've not got so many lines on the screen we can't see what we're doing. We're going to come in here. If I draw enough lines on the screen, market will eventually hit one, and you can say, hey, my system worked. All right, so there we go. That's just a 200 period moving average. That's all that is right there. And I'm very much into the Delta Kona probability. As you guys know, the Delta Kona probability, the students who have been with us before, one of my favorite tools in all the world is the Delta Kona probability. The Delta Kona probability tells us, if we come over here, I've got this little sheet over here we can look at. Let's pull it up right here. And we're going to go to the slides. And many of you have seen this already. For those who are new, Delta Kona probability is this thing right here. Where'd it go? There it is. Delta Kona probability. If you want to look it up on ChatGPT, or you want to do a little research on the web by yourself, the real name for it is the empirical data distribution rule, also known as the 68, 95, 99.7 empirical data distribution rule. I call it the Delta Kona probability because it's easier than to say that big long line. And it's based on delta. And so it's based on, actually, if you're an options trader, you understand what delta is, and you understand that you have what we call convexity, right? So you have delta generally is at 5.0 at the money. And so anything above or below is the convexity of the change in delta as it goes up or down the scale. And so we use delta in many ways. But one of the most popular ways to use delta is as a probability indicator. So we know that the market has a tendency to retrace. Approximately 68.2% of the market stays within that one standard deviation of the mean, which is calculated with delta, which comes from the options tables, right? That's where we get this. And so we have this mean reversion. And so the market has a tendency to retrace back to or fall within these mean reversions. So if the market goes to the top of the mean reversion, it likes to come back to it. If it breaks out of the top reversion, it likes to come back to it. If it breaks down, it likes to come back to it. Markets always like to retrace back to their mean, all right? And so in a process of moving through price and time, that's why markets move forward, 2 steps forward, 1 step back, 2 steps forward, 1 step back, right? They have a tendency to do that mean reversion. And so that's what Fibonacci is. So if you guys are familiar with Fibonacci, if you draw a Fibonacci ruler on the screen, the Fibonacci ruler is really just a mean reversion. It's a delta cone of probability. If I draw that in there, you would see that that same cone is just like this, all right? And I call that the Fibonacci sweet spot, or between 38.2 and 61.8 is that delta cone of probability. And so anytime you draw that in there, realize that the reason why the market likes to go back to that 50% level is because that's the one standard deviation. 38.2, 61.8, that's your 1 and 2 standard deviations. And if the market has a tendency, what did we say, 68.2% of the time to go back to that location, that's how we trade probabilities. All right, we trade probabilities. So anytime you're trading, you always want to trade the probabilities. So we use those tools to help us identify where we think markets are going to go. We do it on a smaller time frame, so we'll draw it up on a smaller time frame. We'll measure the delta cone of probability on smaller moves. We'll also measure the delta cone of probability on larger moves, like this big one move here. So you can see this market went all the way up this big, nice, big, long trend, and then it turned around and it retraced back half or 50% of the last major move, or back into the delta cone of probability, or what we call the Fibonacci sweet spot. All right. So that Fibonacci sweet spot is really, it's just that 1 standard deviation, 2 standard deviations, 3 standard deviations. If you turn on the additional Fibonacci numbers, we come in here, Fibonacci lines 23.6, you can see that we have a 23.6 and a 78.6. That's a 3 standard deviations away from the mean. Not very likely that the market's going to go back there. Doesn't mean it can't, certainly can. Market can do anything it wants. But if we're trading the probabilities, we need to use these tools to help us know, oftentimes we say, well, buy low, sell high. Well, what does that mean? Buy low, sell high. How do I know what low is? How do I know what high is? Well, that's what we do, is we look at these delta cones of probability and we determine whether the market is inside or outside of the 1 standard deviation, the 2 standard deviations, or the 3 standard deviations. If it's way out past in the 1 standard, the 3 standard deviations, well, the market is very high or it's very low. So you can either sell or buy, right? Oh, the market's 3 standard deviations away from the mean. Probably want to get out of that bugger because it's probably going to retrace back to the mean, right? So, it's way down in the 3rd standard deviation. Oh, wow. It's going to probably retrace back to the mean. So that's a good buy. Let's get some of that stuff. All right. So buy low, sell high. Now, a lot of people like to buy high and sell higher. That's a tough strategy. Not really into it, but you can do that. So it doesn't really follow along with the delta cone of probability, which is kind of my favorite thing. I like to do it that way. All right. All right. We're going to come in here and draw all these tools. This is lean hogs. So if we take a look at this, lean hogs come back to that 200 period moving average. Now, why is that important? Well, the 200 period moving average is very much considered to be very close to the standard deviation, the 1 standard deviation of the market, right? So as it crosses through it, you can see like this, as it crosses through it, it's going through what would be considered to be the 1 standard deviation, or the central point. And then that would mean that you could take, if that's the 0 line, or what we'd consider delta 0.50, right? If you're an options trader, you would understand that delta 0.50 is the at the money location, and it's the center of the cone. Well, that's what 200 deviation is considered by large institutional traders. They consider the 200 standard deviation to be the center line of your delta cone of probability. So what we'll oftentimes do is you can just take, and we do this with Fibonacci, but you can just do it with a simple ruler. You can say, I'm going to take this low point down here, I'm going to draw it up to that 200 period moving average, and then I'm going to do what we call a Fibonacci projection, but we're going to do it, lazy man's way. And we're just going to say, well, the market's going to probably go up there. So if this is the center line of the 1 standard deviation from the previous standard deviation to the next standard deviation, that's going to be my projection. And I'm going to figure that the market's going to trade somewhere within that zone right there. And if it's above that zone, well, this is considered too high, too expensive, I ain't going to buy it. Or if it comes back down into the one standard deviation or back to the 50% or the 200% level, that gives you an idea of where this market's going to go, where it's going to be. And we call this entire box right here is called a Darvas box. All right, a Darvas box. If you want to go out and do some additional study, you want to go trade these things. These are called Fibonacci projections or the Darvas box. You could look up Darvas box. Markets have a tendency to make 3 drive patterns as they go through Darvas boxes. So you can look at that, which is called the Elliott wave pattern. Also write down Fibonacci projections, retracements, and rulers. Those are other things that you can look at and study that are going to help you understand this concept of how markets move through price and time. And so how we know when a market, what does low look like? What is a low market? What does that look like? What is it? Well, we have to establish some boundaries and determine what those are. And this is how we do that. All right. So if you want, just for fun, not to, honk my own horn, but I have written all this stuff down in a book. It's the manual to the class. All right. And if you don't have the manual to the class, you can go get it out on Amazon. It's called the Stock Market Playbook of Strategies, and just search Lan H. Turner. And there's an older version out there. Make sure you don't buy the older version, or we had somebody buy a used version and they got the older version. So don't do that. Just get the new version, pay the extra $3 so you're not getting an old version, and it's not very expensive. It's just barely whatever Amazon charges to print the thing, and it's like 280 pages, full color every page. So it's a good little book. It's 8.5 by 11. I wish I got one here somewhere. Oh, I think I gave mine away. Somebody wanted it, and I gave it to them. So I got to get me another one. But it's a great book to have, and it's the manual to the class, and it teaches you all this stuff. All right. So it's good to have, and to have it laid out on your desktop when we're working here in class together. So this is lean hogs, and lean hogs is right back down dead center, mid Fibonacci sweet spot. So if we come in here from top to bottom, we're not really getting a buy signal or a sell signal at this point on lean hogs. So we can't really place an order because we're dead center. Look at that. Right at the Fibonacci sweet spot. So we can't be buyers or sellers at this point. We don't know if this market's going to go down or up. We can do a couple of Fibonacci projections on here. There's an ABC pattern right there. And so that gives us a Fibonacci projection, but you can see it's right there at the 100% level, which brings us back dead center of the last major move. This is a beautiful run right up through here from the bottom to the top as it crossed over that blue line, right? That 200 period moving average, which is the delta cone center. And so that's our projection up. It got us a little topping formation up in here. You can see a nice, beautiful little head and shoulders formation up in there. The breaking of that neckline was a trigger for a short position right in there. You can see. And so that's the way this cookie's crumbled so far. And we get our nice little ABC pattern down here off the bottom. And so that's another little projection to a Fibonacci long position, and that break of that natural trend line right in there. You can come in. You see, we got a little break right in there. Get a little bit more aggressive. We could turn on our chart overlays. We could turn on our ATR, get those dots in there, and you can see that would be another buy signal right down in there. So that's another little buy signal right in there. And so that's how we read charts. All right, it's called technical analysis, and of course we use that in correspondence with the mathematical models that sit underneath the chart. This is called the RSI, or Relative Strength Index, and you can see it kind of moves with the market itself and shows you when the market's up to the top and looks like it's getting ready to make a little bit of a rebound. Again, this tool down here, this RSI, is based on the delta cone of probability. Okay, that's what the RSI is. Many people don't realize that, but that's what it is. The RSI is based on the delta cone of probability, and what it's doing is it's mimicking the underlying market itself, and then it's drawing that delta cone in here. I don't know if I can do that in here with this tool. I think I can. There we go. So you can see that that delta cone of probability is the RSI. So if it's up above that high 70 marker, that means that the market is overbought, meaning that it's outside of the standard deviation, and then the market has a tendency to retrace back into the standard deviation. So that's why people will tell you when you look at the RSI that if it's up here, it's probably going to come back, right? It's going to probably come back as it crosses over that 70 and comes back into the the center line. Well, do they realize that that's why? It's because it's the delta cone of probability. It's the actual standard deviations. Now, there's many indicators that are based on this same concept. So if you come in here and you turn on, for example, the stochastics indicator, I was saying earlier that I really like the stochastics indicator. This one also, let's see, let's turn that off for a second. And I'm going to get rid of these drawing tools in here. And then we can turn on stochastics, and then there we go. So now we're on the same scale, and you can see that the stochastics is very similar in the sense that it has a boundary lines that are set in there with a 50% line that goes through the middle. And once again, that's your delta cone of probability, and it's your standard deviations. Once the mark gets way up to the top of that thing, it has a tendency to retrace back to the center line, or when it gets way down to the bottom, has a tendency to come back to the center line. And so that's your overbought region, your oversold region, and that's your delta cone of probability. And it's a mathematical model that tells you when the market has a tendency to be low or high. So what does low look like? Well, when the stochastics and the RSI are down in the bottom region, that's low. When the RSI stochastics are up in the upper region, well, that's high. And the reason is because of that delta cone of probability and the probability that the market has what do we say? It's 68, right? 68.2% of the time, the chances are it's going to come back down into that center ring. And so that's how these tools work, all working these probability statements. And that's really what they're mostly doing. Okay. You can even see it built into, let's turn off some of these. Let's turn off this one. You can even see it built into other tools like the MACD, for example. The MACD is very popular. And it too works off that same concept of the delta cone of probability, where you got a center line in there, right? And that's your line that the market has a tendency to leave and then turn around and come back to, cross over, go back up the other side, turn around and come across back over to. So this is called a histogram, and a histogram has that center line in there, which is your delta cone or your delta center of probability. And that's what that is all based on. So, whether you're using the MACD, whether you're using stochastics or RSI, they're all working off that same concept of overbought, oversold. Where is that delta cone of probability? What is the standard deviation? How far out is that thing going to go before it returns back to the standard deviation? What does low look like? What does high look like? And that's what they're trying to establish for you. And that's how they do it. They use that delta cone of probability, whether they're MACD, stochastics, RSI. There's so many of them that use that. They all become, basically the same. You start laying them over the top of each other. You got the CCI in there. It's the same thing. You've got the RSI, you got the fast stochastics, you got slow stochastics. Most of these are some sort of based strategy based on the 1, 2, and 3 standard deviations. And so you get kind of the same thing when you start looking at these, and you get the same answer on many of these, just kind of a little bit of a tweak here, a little bit of a tweak there, a little bit different way of looking at the same thing. But really, that's all we're working off of. And in fact, if you take some of the overlay indicators, for example, another very popular indicator many of you have probably heard about is the Bollinger Bands. If you drop the Bollinger Bands in there, well, that's just a 2 standard deviation, single standard deviation envelope that's laid over the top of the chart, right? Again, it's working off that same concept of 1 standard deviation. If it goes up or if it breaks out above the 2 standard deviation line, it's going to retrace back to the red line, drop down to the bottom line. This is how you know when a market is low or high, prices are high or low based on the standard deviation using that enveloping system of the Bollinger Bands. And that's all that we're doing here in many different facets of reading the charts and trying to figure out where the market's going to go so we can be comfortable or confident in our purchasing, right? Buying and selling of these stocks or these commodities. All right, so that's lean hogs. Let's go look at the next one. This is feeder cattle. So let's come down here and pop in feeder cattle. Now, remember, I'm going to turn off some of these other indicators. Let's turn off parabolic SAR. Now, I have the Donchian channel on there, and if you know, those of you again who have been here with me, the Donchian channel is the way I've got it set up is kind of unique. I've got it set up with a period of 100. And the reason I do that is because it takes us a little bit longer to get our Donchian channel to read the market. And so it goes for a longer term trend. And so you can see the standard deviation once again. What am I looking for? I'm looking for that retracement back to the halfway zone. And so if you come in here with a let's go delete this tool. And if you come in here with the 200 period moving average, once again, let's go moving averages. Where's our 200 period minutes? Just starting, because this market, it doesn't have enough room in here to start the 200, but there it is right there. There's your 200 period moving average. And so you can see that it's kind of right there close to the Donchian channel with this last move, but this is the overall, so our little trick here is to just say, well, we're up to the 200 period moving average. We're then going to take this and we're going to say, well, where is that going to go? Well, we're going to look for the top of this market to be on the other side of that. So we're looking like the market should be up above that market somewhere up in here, right? So once it gets up there, that's going to be considered to us, that's going to be high, right? So it's basically that same concept of we're just going to overlay over the top of it based on the 200 period moving average. That's going to be our RSI center line, right? If we're going to do the RSI or the MACD or the stochastics, and in your mind you're thinking, well, where's that center line? If we lay that over the top of the chart, there's your center line. It's the 200 period moving average. So that's where the market's crossing through the center line, and then it's going to go up, and if it comes up above this top line up in here, that would be your top line on the RSI, right? For example. And that would be, oh, the market's way overbought up there. If it's up here, it's a way overbought, and it's going to probably come back down to the 200 period. Or same thing, if it comes way down here, oh, it's way oversold, right? And it's going to come back up into the one standard deviation. And so that's how we're going to look at this. And we know that markets have a tendency to make 3 drive patterns, right? So if we come in here and delete all the arrows, we're going to have 3 drive patterns in here. And so what's going to happen is we come in and we draw that trend line right up underneath that line, just like that. And it looks like it's got a little bit, it's favoring it to about right there. Let's come in and kind of hunch it a little bit. But we got we're in our first drive. So there's our first drive. There's our counter trend. There's our second drive. There's our counter trend. Here's our third drive as it pushes up into that overbought region, right above the 200 period moving average. We're going to anticipate maybe it's got a little bit more upside potential in it. And then we'll look for it to come down. And then what'll it do? Probably break that, probably go up, try to break the high again. Can't do it. And then it'll probably retrace and come back down to that 200 period moving average, or probably somewhere right in that region there. If we draw that in there, we can make a little educated guess, right? That the market will probably go up here, turn around, have a little counter trend, come in here, try to make a fourth drive, but fourth drives are really rare, so they don't generally do it. And that's where we'll turn and have that accumulation distribution model from Wyckoff. Another thing you should write down and go study if you don't have my book. If you do, just look it up in the book. It'll be in there. And then this is where we're going to get the distribution as that market comes back down. Where? Right into the Fibonacci sweet spot. So that's kind of what we're going to look for with feeder cattle. Feeder cattle's got a little bit more to go, but probably not much in there. We can come in here and measure a couple of these and see how much more oomph we think feeder cattle's got in there. Remember, feeder cattle are alive. These are the little guys out in the field. All right, so there would be 100% right there at our projection, right there. So that's kind of fallen right into place, just like a train on rails. So that's how we read charts, and that's how we trade. And then you make your decisions on where you want to get in, where you want to get out based on those movements through that price and time. All right. So that's feeder cattle. Let's come in and look and see if there's something we can see on live cattle. Now, live cattle are dead. Live cattle are dead. These are the ones that are hanging on the rack in the meat house, meat packing plant. Let's get rid of some of this stuff. Too much room, too many indicators. All right. Let's remove this one for just a minute too. All right, let's come in and look at, let's see. Let's go in here and delete all my tools. All right, so now we got this little bottoming formation. Where's our 200 period moving average? Let's always turn that on. Moving average, moving average. There it is. There's our 200 period moving average. So it's sitting there dancing right along that center line. So if we come in here, another little trick you can do, watch this neat little trick. You take your Fibonacci ruler and you just draw it up there, and you put your 50% level right over the top of the 200 period moving average. And that right there, my friends, is your Fibonacci projection, or what I like to call, or what we like to call, that's what we call the Darvas box. All right. And it goes from the low to the high, and that is your Darvas box. Okay. And the reason we call it a Darvas box is because you can start at one Darvas box. And once one Darvas box is complete, well, markets don't just always stay in a channel, right? Sometimes they continue to go higher once again. And that means that we would have a second Darvas box. And we're going to assume that the second Darvas box would be very similar in size and price to the first Darvas box. And then we would have our Darvas box up there like this, and we would have a second Darvas box. And so if we believe that the price of feeder cattle or live cattle, crude oil, whatever, is going to continue to rise above this Darvas box and go into the next set of Darvas boxes up there, the next Darvas box, this would be our Fibonacci, what we call a Fibonacci projection, or a Darvas box projection of where we think markets are going to climb over the next series of months. This one here is making like a 6-month move. So this would be what we'd figure for possibly the next 6 months. If we think markets are going to continue to climb and prices of live cattle are going to climb, that would be a fundamental decision, not a technical decision. What we're doing here is all technical analysis. And so fundamental analysis, well, are there enough cows? Do we have enough cattle to feed the world? You know, how many cows do we need? You know, oh, there's not enough cows. Oh, the price of cows are going to go up. Oh, we got lots of cows this year. Oh, the price of cows are going to go down. Okay, so then you determine whether you believe your Darvas box is going to be the next box higher because we got not enough cows, or, oh, we got too many cows. Oh, okay, we're going to put a Darvas box at the bottom side, right? Or we got the same amount of cows. Oh, well, we got the same amount of cows. Well, maybe prices of cows will stay right here, about right where they're at. We could just assume that the cow price is going to stay the same. So that would be a fundamental reason. But then these are the technical reasons. We need to meld the two of those. Both of them go together because you got the fundamentals that determine where the next Darvas box goes, whether that's bullish or bearish. And then you have the technicals, which help you determine when to enter the price, when the market's too high, when it's too low, when we're coming around those breaking points where we're going to buy into the market. That's a technical setup. That's a breaking of a trend line. It's a mathematical model or whatever, an indicator that gives you a signal that says it's time to go long. That would be a technical tool that's going to tell you the actual entry point or the entry day for a fundamental move that you've determined one way or the other. All right. So that is our Darvas box. And there you go. Pretty cool, right? And so that is live cattle. Live cattle are actually dead. They're hanging in the meat packing plant on the rack. Did you know I used to work in a meat packing plant? I was the kill guy. You know how many cows I've killed? I've killed a lot of cows, and I've killed a lot of pigs, and I've killed a lot of sheep. Never did kill chicken. I take that back. At home in my dad's backyard, I killed a lot of chickens. But I used to work in the meat packing plant, and my job was to kill the animals. And then once I was done killing the animals, guess what else I had to do? I was pretty low on the totem pole. I had to go clean the guts out. That sounds fun. I used to go in with a big wheelbarrow. They had this big flat wheelbarrow, kind of round thing. It was designed to go right up underneath the cow's carcass. They would pull the guts out. All the guts would fall out into this big bucket, and they'd cut that, and I'd take that wheelbarrow into a special room away from everybody so they couldn't see what I was doing. And I had to pick that guts up and put them up on a big table. Oh my goodness. No, it wasn't at Miller's. It was at my uncle's. It was at my uncle's. My uncle had a meat packing plant. It was just after I graduated from high school. One of those things that I did that made me decide college would be a good idea. And so I picked those guts up and I threw them up on the table. I'd have to spread them out, and then I'd take my big knife and I'd find the stomach, and I'd cut the stomach open, and I'd have to scoop out all the green stuff that was in the stomach, and that would go down this chute. And then I had to wash out the guts, and then I had to spray chemicals all over them, and then I had to push the guts down another channel. And then I go back out, spray myself off. I'd have to go in, and then I'd go out and I'd kill some more cows. Nick says he used to do a truck hanging, beef truck. Oh man, that would be even more difficult because now you're dealing with portability and having to go out and drive the truck and go out into a place and find the cows and chase them into your truck. I watched those guys do that. That's hard. I mean, what I did was really, I don't know. I loved doing it. It's one of those jobs that you really hated, but you loved doing at the same time. I kind of missed it. It's kind of like, oh, I can go do that again. Kind of fun. And then we had the USDA stamps, and we had those guys that would come in, and you had to take and I got to do that. That was my job. I got to put the little stamp on there and go into the coolers and do the little USDA stamp. So it was fun. Oh, you did the dead ones after they were already dead in the field. You know what? My dad came to me one time, and my dad had a whole string of gas stations, and so I worked at the gas station as a young kid, and I worked at a lot of gas stations. I've worked at a lot of gas stations, and so I use that as a lot of reference in these classes. Like, you can do the gas station thing because I used to work at gas stations. My dad came to me one time, Nick, and he said that to me. And he's like, Lan, you're sitting here working for $3, and he was giving me a minimum wage at the time was $3.25, and he was giving me $3.50. So I was feeling pretty, pretty high on the hog there. And he came to me one day and he said, you know what? I was out in the field. And we used to have these big delivery trucks where we'd drive fuel out to the farmers, right? So that was what he would do, and I would work at the gas station. He would drive the trucks out into the fields, the farmers' fields, and fill up their big tanks so that they could fill their tractors up. And he says I was out at a feed yard and a cow had died, and it was dead in the shit pile, right? And he's like, I saw a guy come by with a truck and it had a winch on it, and they'd hook that winch up and they would drag it out of there. And he charged him $100 to pull that dead cow out and take it up to the junkyard. And I think we should do that. I'll get the truck. I've got the pickup truck. I'll get the winch and we'll put that on there, and we'll go out and you can walk out into these shit piles and you can hook the cable around these dead animals and you can pull it up into the pickup truck and take it up, and you'll get $100. That's a lot more money. You only have to do one or two of those a month, and you could make way more money than you're making here at the gas station. You want to do that? Should we start a new business? You go out and shit holes and pull dead cows. I said, no, Dad. No, not for me. Sorry, Nick. Not something I want to do. I stayed at the gas station and worked for $3.50 an hour instead of going out and walking around in cow shit holes pulling out dead animals. I didn't want to do that. But I did work at the meatpacking plant and killed a lot of animals. Yeah. All right. Enough pontificating. Let's get back to the business at hand here. What did you do with the dead cows after? Did you go out and did you dispose of them, or did you cut them up? And because we had a cow in our neighbor's yard that bloated, right? Ate too much, got out into the green pasture and bloated. And my dad, had a tire shop next to it, and he had all these. I was just a kid. I was a little guy, probably, I don't know, 10 years old when this happened. I remember. And the cow bloated, and it was, big and fat and round and laid over on its side. And my dad went running out there with a knife from the tire shop, one of these big rubber knives, because he used to recap tires. So he had one of these big, long rubber knives. And he went running over there to the cow, and he stabbed it in the back, right above, I don't know, back up in there. And he let all the air out, and the air was spraying out of this cow, trying to, because it bloated, he was trying to get the air out so that it could live. They were trying to get it up on its feet and stuff, let the air out. They stabbed it. I don't know if that's the right thing to do, but that's what they did. And so the cow ended up dying anyway. So they strung it right up. They took it over, drug it over with the truck and into the barn and hooked it up, hooked the legs up, strung that thing up and fed it to the family. I guess I'd know the dead ones after they were done with them. No, the dead ones after they were done with them. So you did a little bit of both. Yeah, it's crazy, man. A lot of stuff, a lot of fun things out there when you're living in the country with the farm folks. I wasn't much of a farm folk myself. I worked in the gas station. My dad had a farm before I was born, and he worked out on the farm and ran cattle and everything. But that was all before I was born. And then he went and decided he wanted to be a tire shop man and gas station man, and he did all that kind of stuff and bought all these gas stations and tire shops. And so I had an opportunity. He had a Radio Shack, a Western Auto, he had a hotel, he had a cafe, but he was like a big shot in a little pool. We were down there in central Utah in a small town, but owned half the businesses in town, kept everybody going. So it was a lot of fun. I got to work in all those businesses. I got to work in the cafe. I got to work in the hotel. I got to work in gas. My gas station was my favorite. I liked working in the gas station. And then my uncle had the meat packing plant. I went and worked for him after I graduated from high school. Killed a lot of animals. That was a lot of fun too. Anyway, nonetheless, that was my foray into the futures market, into the commodities market. And that's how I kind of have a little infinity for it. Plus, my dad, um, being in the oil industry, right? We had a big bulk plant. So we had one of those, if you drive down the side of the road, you see all those big oil tanks, gasoline tanks. They're full of gas and oil and diesel. And we had one of those. We had a bulk plant full of where he'd go down and he'd have all these trucks that would come in. And did that for a while. Drove one of the trucks out into the farm fields and filled up. I didn't like that so much. That was hard work. Dragging, carrying hoses and climbing up ladders and filling up tanks and stuff and driving trucks around. I did that for a couple of years, and then decided that college was a good idea. And then that's how I would watch my dad call on the phone every day and get the price of crude oil, get the price of unleaded gasoline, get the price. And that was my first entrance into, hey, what is the price of crude oil? What is the price of gasoline? What is the price of, all this stuff that we're selling, oil and everything. And so that was kind of my first watching him do that, wishing that there was a better way to understand how these markets prices were going to move, because we had to do a lot of forward contracting. We had to bring in all this crude oil, all this oil, not crude oil. We didn't actually do crude oil. We did diesel and number 2 and number 1. And we did, unleaded gasoline and regular gasoline, super gasoline. We had all that stuff. That's what we did. And so we had the bulk plants that we'd fill up all the trucks and we'd haul it around and fill up the gas stations and fill up all the farmers' trucks and stuff. That was my foray into it. So I've been in the oil business, I guess my whole life, really. I mean, until my dad died and sold off his oil business. But that was kind of the family business. We were oil man, kind of. I used to take baths in gasoline. Not a joke. Not a whole body bath, but man, we would go out and take a jug of gasoline and pour it on us like this, wipe it all the dirt off and all the oil and the grease, and rinse us off with some fresh, clean gasoline. And it's not a joke. We used to do that all the time. That was just a thing we did. Our house smelled like gasoline and smelled like diesel all the time. You walk in, oh, I'm home. Must be home. Must be the Turner house. It's called Turner Oil. Turner Oil. So anyway, I guess reminiscing here a little bit. We're going off into this live cattle. What do we think live cattle is going to do? I think live cattle is getting ready to drop. We got a little bit higher up that we can go. Let's just take our little dollar calculator just for fun, just off the bottom here, up to our 200 period moving average. And we're going to take that same distance. We're going to go from the 200 period moving average up to the top. And that's where we get that. That's where I drew that Fibonacci ruler. So that's where we're going to get that top location. So that kind of gets up into this region up in here. We're going to start looking for an opportunity to take a short position, right? So we'll look for feeder cattle or this live cattle to come back down. Now let's draw a dollar calculator on here so you can see. Well, I got one on there now. I guess you can just look at that one, but you can see from that 200 period moving average up to the overbought region, right up to the top of that that projection zone. That's a $4,650 move in live cattle. And you're like, well, $4,600 move. That's really nice, Land. How much does it cost to put that $4,650 move on? What's one contract cost in cattle? Let's come over here to the key and we can see that our initial margin is $2,400 and our maintenance margin is $2,200. So initial margin means you put it on today, they're going to require $2,400 in your account. And then the day after that, if you keep it overnight, well, the next day they only require a $2,200 margin. So that is what it would cost to put a position on in feeder cattle or live cattle in this case. Feeder cattle, I think it's a little bit higher. So we're going to come down here. You can draw your trend line. You can actually come in here and turn on our little helper here, our little cheat codes. We'll turn on the ATR. And then there's our little buy signal right there for that last run, bouncing off that 200 period moving average, headed up that line right there. Let's just see how much that would have been. If you'd have got in on this little break right here, and the market's currently there, it's a $2,780 move on a $2,400 investment. All right. So that's pretty cool. Double your money right there. That's a nice move, 100% move right there. But that thing kind of bounced around that little 200 period moving average there for quite a while, didn't it, before it decided it wanted to take off and rally once again. But live cattle, prices are rising. And now you can start thinking about, hey, why are live cattle prices rising? Nick says, I used to haul frozen pork bellies. You know what? We used to trade pork bellies. I've traded pork bellies on the futures exchange. I had to do it. It wasn't like I was like, oh gosh, I'm a pork belly trader. But it's one of those things where it's like, geez, you know what? You can't be a real commodity trader if you've never traded pork bellies. So I had to put a few contracts and trade pork bellies just so I could say I did. So I've traded pork bellies, but they've delisted pork bellies now. You can't even trade them anymore. Pork bellies are what? Everybody knows, right? Pork bellies, that's bacon, but we don't trade bacon anymore. All right, we could haul 45,000 pounds in one reefer. Pork belly loads are always light. Huh, that's interesting. I learned why when I took a Ken Roberts commodities training course. You were hauling one CME contract of pork bellies. Yep, that's right. It's the same with corn. If you go out and you look at one train car of corn, that is one contract of corn, not the micro, but the mini. One mini contract, or we don't do minis. We do micros and standard. One standard contract of corn is one train car of corn. So, yeah, exactly. You got 40,000 pounds of CME pork belly. So if you come in here, you can see that the contract size right here on live cattle is 40,000 pounds, just like you're saying. So you're saying that was the same thing with pork bellies, was 40,000 pounds. Again, they delisted pork bellies. Unfortunately, you can't trade bacon anymore, but that was, I had to trade it just to say I did. I've traded pork bellies. And if we go over to feeder cattle, let's go back over to feeder cattle and go into the key. This one here, I see it's got an initial margin of $4,000. There's got a lot more that we have to put up to control one. But of course, you make more money too. I mean, this run from here to here, that's $6,300. Whereas, of course, live cattle is a little bit smaller. So, usually, feeder cattle is nice because it trends nice. Once it starts to trend, it generally stays in the trend. It's a bigger commitment, though. You have to put up like $6,000 to get into it, or $4,000 to get into it. So it's a bigger commitment to get into the market, but and your stop, it's a big move, right? I mean, but the nice thing about it is when it trends, it does trend nicely, and it does follow the technical analysis moves very nicely. I mean, once it goes green, oftentimes it'll stay green. You got a pretty good chance it's going to continue to move. Live cattle, not quite as clean, I would say, in my experience, as feeder cattle, but nonetheless still pretty good. And it's a smaller contract, so you don't have to commit quite so much to get in. So your risk versus reward ratio is not quite so big. So that's that one. And then lean hogs. Lean hogs, let's go look at the key on lean hogs. This is the only thing left in the pig world. It's 40,000 pounds as well. And so you've got an initial margin of $1,600. And I've traded lean hogs, and I went through my stages, where I was like, oh, I got to trade lean hogs. I got to trade pork bellies. Oh, I got to trade the meats. I'm a meat trader. I went through that stage. It was short-lived. These are big markets. And so, that's where you end up saying, well, I think maybe I'll do a little day trading because I can come down to a little shorter term time frames and not commit such a big dollar amount. So when you're wrong, it kind of hurts. It's painful, bites. So we can come down to a 2-minute chart on these things. The problem is when you start looking at 2-minute charts, this is the kind of trends you get in lean hogs, live cattle, feeder cattle. That's not really fun to trade on a smaller term time frame, and that's pretty typical move for a daily move on lean hogs and cattle. You can see that's a nice trend, but they're rare. You see, I don't get a lot of those. That's why we like trade the indexes when we're going to day trade, is because we get lots of really nice moves. But this is pretty typical for the meats in general, commodities in general. This is kind of how they trade. Not real exciting and crazy on the shorter term time frames. So we generally trade them on a longer term position trade. That's just the nature of the beast, right, guys? All right. So we have kind of covered pigs and cows a little bit here today. We're going to keep with this theme, and we're going to go in and we'll look at crude oil and gold and silver and some of these other commodities. I want to look at wheat and soybeans, and we're going to cover a little bit of the family nature of the markets, and we're going to still stick with this idea of the the cone of probability. Hopefully you guys enjoyed what you learned today, and that's going to be helpful. And these tools all work, whether it's on a daily chart or a 2-minute chart or a 1-minute chart or a range bar chart, we still go with the cone of probability. We still go with that mathematical modeling across the board. That 200 period moving average works just the same on a 5-minute chart as it does on a daily chart. So use these tools to help you identify overbought, oversold regions, where markets have a tendency to go, what high looks like, what low looks like, and use those as your base structures for determining when markets are good times to enter, get in, get out, invest in. Whether you're using it in the stock market, you can use the same idea and concept. Oh, when do I want to get into this market? Well, wait until it's down below that 200 period moving average, turning and starting to curl, and that's a good time to start putting money into a market. You don't want to be getting into a market if you got that 200 period moving average and it's way up there to the top, unless you're going to be taking short positions. All right, because that's markets getting up into that, outside that single digit cone of probability. So I hope that was helpful. I've got a little Sunday school lesson for you. Don't be me is what this Sunday school lesson is. Don't avoid trading out of boredom. I have a tendency to overtrade because I love it so much that I don't want to do anything else but sit around and trade. It's what I do, like 23 hours a day. That 1 hour that I sleep with one eye open is the one eye is on the markets. And I know it's bad, probably why I had a heart attack. But nonetheless, this forces dumb trades. It usually is because of slow market conditions. Don't chase productivity and have realistic expectations. All right. Sometimes the markets are slow and move. And we have to realize markets go up and down and up and down and up and down. And we're going to have days where the market goes down. If we're going to be long-term investors and position traders, we got to realize that we got to sit through some of that stuff. And we're going to work on setting up our UBI, Universal Basic Income. I'm working on those spreadsheets. I did a little bit more work on them today. I do want to get those to you. For those of you who have Pitt News Magazine, you'll get those for free, along with your subscription to Pitt News Magazine. If you don't have Pitt News Magazine, it's on sale right now. Run over and get it. It's only $19.97 for an entire year. And that's going to go up. We're going to change that here as soon as I can get my marketing people to make that change. They're going to change that, and it's going to go back to a different pay structure. So if you're interested in the Pitt News Magazine and you'd like to get all these spreadsheets and stuff that we're using here as complimentary given along with the subscription service, go grab it now, $19.97, because that price is going up here not too long, as soon as they can get to it. All right, guys, that's it for me. That's our Sunday school lesson. And if you have any questions, please let me know. Leave some comments out in the comment section. If you thought that this was good and you learned anything today, thumbs ups are always nice. I always like to see those. And if you haven't subscribed, make sure you subscribe, because we only do live classes here. I don't send out lots of pre-recorded, cherry-picked videos. Everything here we do is live, and so make sure you subscribe and click that little bell so you know when we're going to go live. We try to go live Mondays, Wednesdays, and Fridays in the morning, and then Tuesdays and Thursdays in the afternoon. And we will catch you guys. And remember, Thursday the markets are closed. Jimmy Carter's ceremony, so that's on Thursday. And today is Tuesday, so we'll see you tomorrow, Wednesday morning, bright and early in the morning at 8 o'clock a.m. Mountain Time. That's 10 o'clock Eastern. See you tomorrow.